Hello, everyone. Welcome to today's session. Let's get underway. We've got had a massive rally yesterday, and we have FOMC coming up here in about an hour or so, and so we could that could add some additional volatility to the market. Let's look at this long-term picture. Um, uh, Market conditions still bullish, or I should say, have moved to bullish. Uh, in this bull market, have a bull market rank of 26.2. That represents this momentum area. When we are in a bull market or a bear market, we're looking for where are we at in that trend? Are we and essentially the zero line, it's not quite that zero line, but that zero line is when we get these moves here. If we're above that zero line, we're in this long-term uptrend. If we're below it, we're in a downtrend. So it is a very slow-moving indicator, but it also is an indicator that helps us look for the extremes of a trend, or where are we at in a trend. We've talked about the sustainability of a trend. If I were just to draw, on average, a lot of times on a stock chart, you're getting this 45-degree angle. Stocks or markets will typically move, sustainably within that overall uptrend. But we get these really big wide swings to the upside. We overshoot to the downside, we overshoot to the upside. And that's typically what markets will do. And oftentimes this is referred to as reversion to the mean, and that is just reverting back to the average. What's a normal, sustainable move? When we're in these uptrends, we get markets that move higher. This is not sustainable. When they move lower, this is not sustainable, and typically we're dealing with an average. So it would be ideal if stocks and markets moved quite like this, but they don't, because it's an auction, and all of the participants are human beings, or they're human beings that have programmed algorithms to do things that they want to do, and that ultimately is anticipating the future, and no one can do that. So it becomes these volatile type sessions of ups and downs. What is everyone else doing? Are we running for the door, or is there blood in the street? Are we extremely euphoric? Do we have this greed and fear cycle that's happening? And that's a part of what makes a market, because there's always two sides of it. I believe it's going down because of XYZ, and someone else might believe it's going up because of XYZ. And we're making our decisions based on what we anticipate the value in the future is going to be of an individual stock or of a market. And that's just simply a supply demand. If there's more of us that believe that it's going higher and we're buying, then obviously that is going to push prices higher. If there's more of us believe that things are going lower and we're selling, then that is going to push prices lower. So we're sitting right here, had a big move, and this anticipation in this big spike in the market was simply because let's go to the S&P 500 directly. Simply because you had Trump winning the election, and that is perceived as a good thing for business, a good thing for the economy, a good thing for and typically at least the perspective is that taxes will be lower, regulation will be less, things will just be made less friction for businesses ultimately to operate. Interest rates may be lower. Not that the president has any control over any of this, but it is the perception that that type of administration is going to make business less friction, lower taxes. Now, we're not going to get political because that is never helpful, but it does. Whether or not if you've been doing this long enough, you know that the politicians are always talking out of both sides of their mouth. It's just what they have to do. So the truth is somewhere in the middle, and in most cases, the hype is going to go away, and when the rubber meets the road, more than likely Trump doesn't have all of that much control, or as much control and power as everyone thinks he does. It's still a market-driven economy, and yes, it's the perception. Obviously, now the market is perceiving and believing that this is going to be a good thing. We'll see if it lasts. Okay, so we get these big spikes moving into the seasonality is here as well. Political years are often very good years for the stock market as well. And again, it's based on price activity. Obviously, there was a lot of demand that believed this was going to be a good thing for the economy and for stocks, and that's fantastic. So let's move past that now, and now the market is going to start moving past that, and they're going to start looking ahead, and they're probably going to start looking this afternoon to interest rates and see what the Fed's perspective of the economy is, and right now that's this price pattern, things are moving higher aggressively, and that's just the state of that we're in. Whether it's good or bad or one way or the other, it's just what it is. The market does what it does, and we try and anticipate that trend. We try and ride with that trend and not get stuck holding the bag when we are at the top end of a trend, when we are quite extreme. Now, that extreme level doesn't necessarily mean we can reverse, but it does mean that we're going to have some kind of a sideways consolidation, and as of right now, we'll continue to watch that going forward. Let's jump over and talk about a couple of other things moving forward that are going to be points of interest, and that is the bond market. The Fed, the FOMC meeting today is going to also be quite telling. The bond market does not believe that the Fed can or should be cutting interest rates as it's falling. Interest rates are rising, so it'll be interesting to see this disconnect between the Fed and the bond market currently, and how that ends up equalizing and moving forward. Let's jump over to the. Let's see. We talked about. I wanted to go over indexes. Or not indexes, but sectors as well. We had a big shift in sectors as in that rally yesterday, pushed almost everything out of that hold and sell range back to buy, and again, really aggressive move higher. Really, nothing stuck in hold now. It's either in an uptrend or it's not. The bulk now back into uptrends, so we can adjust. Again, all this means is how are we allocated towards risk of these individual sectors or the market as a whole moving higher or moving lower? Do we anticipate they're moving higher? Well, they are moving higher. So once that starts to happen, we're either positioned positioned for that move, or we're not. Whether it's up or whether it's down, we're still managing risk. So at this current level, based on where the market is, because of the extreme level of where we are at in this trend, we want to be paying attention to that risk. And again, that is primarily our job as individual investors and traders, is to manage risk. The market does what the market does. We've got to, we're either going to be with it or not. We're going to be on the right side or not. We're going to be in trades or we're not. We have no control over what those trades ultimately do. And that is a part of managing individual trades and stocks is the possibility of more volatility to the upside or to the downside. We don't want to be overly greedy and speculative and just throwing money at this market at this point in time. We still want to manage the overall risk. And in my this portfolio that we're managing relatively conservatively, we are currently still right around 25% holdings, and the rest in cash. Okay, so we've had a few things happen here in the last few days that I want to talk about. One of the things I want to talk about is I want to talk about stop management and how to manage stops, how to deal with a stop out, what that means, why stops are important, why they are not important, depending on your perspective, when they should be used, when they shouldn't be used. There's lots of discussion about this, and so I want to go through and just talk a little bit about this methodology for managing stop loss. Number one, the initial stop loss. When we're talking about stop losses, we're talking about risk, okay? Because stocks are risky, meaning that there is a chance of us losing the initial capital that we put in. Let's see if we can find an example here, and let's go with this one, okay? And we'll talk about this setup, because this is a setup that we often look at. We look at confirmation bar above this location, This is a confirmation bar. We've got increasing volume. It's already in momentum, so we're anticipating more upside. That's the bet that we're going to take. We're anticipating that it's going to move higher, so we're going to buy into that move. Now, we've got to decide at what point, if this trend doesn't continue to advance this direction, but it starts to move this direction, at what point are we going to say, I'm out. I'm done. It's not moving the direction I anticipated. I'm losing capital now on this initial trade, and I don't want that to happen. What typically happens is most investors or traders will buy into a stock, and if it goes up, great. If it doesn't go up, it turns into I believe in this company, I believe in this stock, I believe in what they're doing. It's obviously moving higher, from this $90 range. So I don't care. So I'm okay with no stop loss at all. And that turns into a longer term investment is what it turns into. And potentially it turns into a massive dog, because stocks can, these high flyers, they can reverse, and they can reverse quickly. So the mentality is, I don't want a stop loss, because what if I prematurely get stopped out right here and it immediately finds support and it immediately bounces? Okay. Well, that's just a part of this game, is we're going to get stopped out, but we can manage the risk based on that mindset of if I don't want to get stopped out, I'm willing to allow some volatility here. Then what should I be doing? Should my stop loss be relatively tight? Or should I have a little bit wider stop loss to allow for that volatility? And we have control over that. And the control that we have over that is our position size. So if we were to take a trade on this and let's say we're using our 2 to 2.5% allocation, and we say that, let's start out with, we can't go 100 shares. Let's go 10 shares, $200 stock, 10 shares. That puts us at 2% risk allocation. Okay, now this is the initial step one of risk management, and that is how big of a position size. Position size meaning how many shares am I buying of a stock. And the reason why this is a risk management parameter is because if I invested my entire portfolio in this stock, I may have I may crush it. Okay, this stock may take off. It might go up 30 or 40% in a few days. Maybe it goes up 100% over the course of a few months, and my 100,000 is now 200,000. What most people don't think about is the risk associated to putting all of your money into one stock. Okay, there is a risk to reward relationship. Okay, so what could happen here is something like this. Let's look at these. I've got two examples here. One is OPFI stock pattern has started to move back. Oftentimes in this momentum zone, because stocks are moving in these momentum ranges, and as they're moving higher, we're using a trailing stop. And a trailing stop is simply just moving your stop loss higher as a stock goes up, because at some point it's going to move up, and at some point it's going to reverse and come back down. Okay, and we want to be out of that trade somewhere around here. We want to give it enough space to have some volatility without getting stopped out, but still allowing it for more upside inside of a certain zone. And that zone that we typically use is a 6-month time frame and a 236 support area. Oftentimes that becomes this support that's right around a technical support area. If you think about these areas right here as support resistance, supply demand, when they break out of these areas and they retest these areas, typically you would expect there to be more buying. If the demand is still there, it's going to happen. You're going to get prices that move higher, but there are times where it's going to dip back down just a little bit deeper and we get stopped out. Okay, and the reason we get stopped out is because we've already decided in advance, I don't want to risk having this loss of 5 or 6 or 8 or 10% turn into a potential loss of 20 or 30 or 40% to the downside. So let's look at this one. Actually, I've got another example here. I've got this one, which is FTEL. Similar pattern, started to move to the upside. It's a little bit deeper than the 236, but for this illustration, I just want to show you what happens. And part of the reason of using stop losses in this case, if we had bought, let's say we bought this breakout confirmation bar back here, it had moved higher, We were adjusting or trailing our stop along the way, and we decided we're not going to use a stop loss on this one because, hey, this thing has gone from 9 to 30. What's preventing it from moving higher? So we don't set a stop loss in place. It moves lower, okay, and bam, moves lower, moves lower, moves lower. The entire rug just got completely pulled out from underneath this stock, okay, and ultimately just continues to move lower. So it goes from a $30 stock to a $12 stock in just a matter of a month, a few weeks. So in this case, we would have said, I sure am grateful that I used a stop loss. Otherwise, I would have had this loss. And that is the whole point of a stop loss, is we don't know if this is going to happen or not. And I don't want to have to wait now for this stock to go from 12 back to 30. Okay, from 12 to 24, from here to here, that is 100% move. The stock has got to go up 100% from where it's at. It's got to go up almost 200% for me to get back just to this location to where I would have been stopped out. So the future is always unknown and it's uncertain. And so we've got to be able to mitigate that uncertainty the best way we can. So in this case, a stop loss, we would have been grateful that we had this stop loss. Because it was a certain line in the sand that we determined that we're going to get stopped out. Now let's look at a similar pattern. This pattern, it's finding support right here. This is relatively recent. You go a day or two. Let's say that we did get stopped out on that day. Let's go to the next day. Let's see if we fall a little bit lower. I think that was it. So let's say we had the stop and we did get stopped out here because we said, I don't know if this is going, it's got the capability of dropping. It's a $4 stock dropping to $3. Yes, it rallied back higher, but maybe it doesn't. So I'm setting my stop loss in this place right here, and it goes even higher. And we're stopped out, and then today it's up 17%. Okay, this is a scenario where we've got to say, I followed my plan. I set my stop loss so that I didn't run the risk of losing more than was an acceptable amount for my portfolio. And that acceptable amount can be determined and should be determined on every single stock that you buy and every single trade and every single day, honestly, to be able to look and say, okay, this is now new information. If we were in the trade, we're managing stops differently. In this case, we got stopped out, and that's frustrating. So if I were to buy, let's go back to this example now and say, if I don't want to run the risk of a stop out, let's set this stop up for this case right here and say, let's go 10 shares. The position size is 2,600. 2,600 is going to be the full amount that I have at risk. If this stock were to retrace and drop all the way back down to 132, I've got 2,600 on the line, and I may be able to be okay with that. If I don't want a stop loss at all, I'm not saying that you should always have a stop loss, but if you don't want one at all because you really do believe this thing's going higher, and if it did fall 50%, you're okay with that. That's kind of a Warren Buffett style. Warren Buffett believes so much in his entry models, primarily because he's done all of the homework and he's buying the business. He knows that this business is not going anywhere. It's going to grow, and ultimately the stock is going to grow. But maybe the stock is overvalued because traders, investors have bid the prices way up, and it's overpriced at these levels. Then it could potentially, he's willing to have a 50% or more retracement because the company is not going to go out of business. He's okay with that. Are you okay with that? That's another question. And are you okay with that 50% or more volatility on 2,600? If you're not, then the way to be able to adjust that is with your position size. Maybe we cut that number in half again and we go down to 1%. Now I'm 1,300 at risk, and 50% of 1,300 going down to $600 or $700, then maybe I'm okay with that, not using a stop loss. But this would be my gauge. This is the lever that I'm pulling to manage my risk at this phase, and that's the size of the position. How big of a position am I putting on? How many shares am I buying? Because I don't want a stop loss, I have to manage it another way. And you may be okay with that full 2%. Again, it's entirely personal to what your trading plan is and what your goals are, and say, I just don't want to run the risk of getting stopped out, because these stocks can really, they're high flying. They may drop by 20 or 30%, but they may go up by 100% in a relatively short amount of time. If I'm not okay with that and I want to have bigger position sizes, then I need to have a stop loss in place. But maybe I don't need such a tight stop. Maybe I'm okay with plenty of range all the way down here, and give that stock plenty of time to dance around up here and even miss out on this move here. But I'm okay with that. So if we go down to a stop, let's say our stop is at 173. Okay, that puts us at 0.75. That's a little bit higher risk. In this, again, for this portfolio style, we're using 0.3. But if you're willing to take a little bit higher risk in order to get that higher return and potentially not get stopped out, then you still always want to know what your risk is. What's the worst thing that can happen right here? The worst thing that can happen is, maybe they have an earnings announcement, or, an FDA if they're a drug company, or litigation, or lots of things can happen that can really gap the stock lower. And what was there was a couple that were recently, I can't think of them off the top of my head, but where you have a news item that really moves the stock, and it's unknown. They call those a black swan event, where it's just completely out of the blue, and it can really move the stock. That is always a risk. Market risk as well. The market moves up, most stocks are going to go up. The market moves down, most stocks are going to drop. So just the very fact that the market is moving lower can add extra risk to an individual stock holding. Okay, so the two factors are the stop loss. So here I have a really wide stop. I'm risking a little bit more, but in anticipation that if it does have volatility, I think demand is going to step in before it ever gets to this level. If that's the case, then I'm fine. If not, I still at least have a fixed amount at risk in the trade. Okay, so point being that there is no exact perfect way to do something every single time, because your situation might be different. Your risk tolerance might be different. Your skill level might be slightly different. Your ability to handle risk might be different. Okay, if you don't have any idea what you're doing, then you definitely want to have a small position and probably a pretty wide stop as well, to say, okay, I'm only going to go 5 shares, and maybe I'm having a wide enough stop to allow some volatility, or only 5 shares, and maybe I have a little tighter stop and I come up here at 180. Okay, ideally your stop loss should be below some kind of major support area, because that's where all the demand is. And if there's new buyers that are coming in at those locations, then ideally we don't want that to dip down and stop out of a trade right here. So those are two of the things to be focusing on for risk management: your stop loss, your position size, and then realizing that anything can happen at any time. And that can blow up a portfolio if your risk is too high. Some of you may have experienced that. Some of you may have said, "Hey, I want more bang for my buck, so I'm going to buy options instead of the stock." And then now you're adding a whole nother level of additional potential risk, where the option can expire. You're dealing with intrinsic and extrinsic value. There's a lot of other factors. There are lots of other vehicles like futures and options and things as well. We're primarily focused on only stocks and building and focusing on these kind of stocks that are doing this, exactly what we're doing. And that is moving higher. And we want an opportunity to get into some of those trades as they are trending higher and as they're starting to move higher, and they're based on great companies, and they're growing and they're making money. And sometimes those can get away from us and they can really start to move higher. I wanted to talk also a little bit more about what happens when a trade gets away from us, but we'll cover that on Tuesday. If there's an opportunity to say, "Oh man, I missed that one. What should I do? Should I chase it or should I wait to come back in?" We'll spend some time going over that next week. That'll look for today's update. Everyone have a fantastic day today.